questions that you have related to macroeconomics, monetary economics, before we proceed today with commercial banking. Any questions? Yes?
We have a lesson on stock.
Not in macroeconomics. This is proper for financial markets course. Usually corporate finance teaches about stocks, about the stock markets. There are other courses, certainly not in macroeconomics, not part of the course. More questions? Anybody? You guys gotta keep asking questions, or if not, I'll keep lecturing. Alright, so we begin with banking. Alright, so banking, let me backtrack a little bit. So far in monetary economics, we started out with money. We did 5 lectures, 5 chapters, money, demand of money, supply of money, value of money, etc. Now we shift and transition from money to banking. Banking itself is divided into major big pieces. One of them is called commercial. And the other one is called central. I really don't want to get into investment banking. It's a whole different world altogether. So, let's do commercial banking. Say shortly what it is, then say shortly what central banking is. And for the next couple of lectures, we will focus on commercial. We'll cover the commercial, and then a couple of weeks from now, we'll move on to central banking. So, commercial bank is a financial institution which accepts deposits and makes loans. So, number 1, accepts deposits. Number 2, makes loans. Sometimes, let's be clear, because it's not all over the world, for the US law says that these loans must be commercial loans. Again, Bulgarian legislation is different. They also apply for personal loans, other European legislation, etc. We're not that much concerned of the very nature of the loan. The key word is, there is a loan, hey, it's a bank. But there's got to be also a deposit. Let me immediately, as I've been teaching this many years now, counter the first question. Sometimes people say, a bank just takes people's money and invests it, alright? Invest? No way. If it's going to be investing, it is not a commercial bank. You got hedge funds, you got mutual funds, you got all sorts of institutions which deal with investing other people's money. We call these, surprise, investment institutions. I'm not talking at all about investment institutions. This is a whole different world. Money and capital markets, it's a course in investments. We don't care. We care about not the investment environment, we care about the credit, about loans. So, we zoom in on loans, and probably, hopefully by next lecture you'll understand why. The answer, let me give it straight up front. With deposit and loan banking, when practiced simultaneously, commercial banks create money out of nothing, or out of thin air. The creation of money is the key to understanding everything else. We simply call it inflation. So, that type of commercial banking is inflationary, and so we studied in macro because it is at the heart of monetary economics. Those investment institutions do not create money, are not inflationary, and therefore we don't care that much about them at monetary economics. Well, why do you care about inflation? Well, the last part of the course will explain, because it becomes the driver of the business cycle, booms, busts, recessions, depressions, and all of this stuff. Is this good enough for now? All right, well, so now on to central banking. So a central bank is a financial institution. You gotta understand, mutual funds, hedge funds, insurance companies, they're all financial institutions, right? So this is a financial institution which is in control of money supply and is legally responsible for the regulation of the banking system. So, for a central bank, let's try and put in an arrow a little here. Money supply and I'll just shorten it to financial regulations. Now, if it is responsible for the control of money supply, we do have a simple name for it in economics. How did we call it? Monetary policy. So, the central bank, we can restate, say the same thing over again, is responsible for monetary policy, or for, with the word is, implementing monetary policy, and for financial regulations. Okay? Now, why I'm using financial regulations? It's a little bit tricky. I'm trying to be evasive. Here is why. Many central banks in the world are responsible for the regulation of the commercial banking system. Only for commercial banks and nothing else. Other central banks are responsible for the overall financial system, which includes, again, if you would remember quite a few lectures ago, all of those financial institutions, okay, mutual funds, hedge funds, and private equity funds, insurance companies, and everything else. And of course, some central banks would be responsible only for commercial banks and a few others, okay? Alright, so is it clear so far? Any questions before I move on to the next big thing? Anybody? Alright, so let's try to do this. Commercial banks have two functions: accepts deposits and makes loans. If it accepts deposits, it's engaging in the business of deposit banking. So, accepts deposits, we say, number one, deposits banking. Alright, so this is how it's called the function of accepting deposits, alright? Nothing more, nothing less. And of course, what's the next best guess? Loan banking, correct. So number two is loan banking. Okay. So, of course, and you at least should know by now, Chapter 6 is actually called loan banking. So, we just put in here Chapter 6. And deposit banking, we put in here Chapter 7. My goal for today, roughly 50 minutes or so, an hour, is to cover completely loan banking, which is simple, straightforward, and then move on to deposit banking and only cover Section 1 of deposit banking, so-called warehousing. Okay? So that's the game plan for today. Any questions before I shift to chapter 6, loan banking? Any questions? None. Alright, so let's take a look at loan banking. With loan banking, what we need to, or at least you guys need to understand, is the so-called T accounts, which the book is using. I go one little step further and just go straight forward with a balance sheet. So let's write out here the next concept is that of a balance sheet. And a balance sheet is simply a complete and extensive list of all assets and liabilities of an entity. So, now I gotta explain 3 words: assets, liabilities, and entity. Alright, let's try the simplest one: entity. Entity is the broadest word in the English language, at least generally accepted English language, even within the law, that describes a unit of something. An example of an entity is US government or Bulgarian government. Another example is a state, the state of Ohio, the state of Florida. Another example will be a school. Another example will be a hospital. Another example will be IBM or General Motors. Another example will be one student. Another example will be an individual. Another example will be a household. So, any government, business, private, for-profit, non-profit, individual, household, any unit of account is simply called an entity, and all of these are examples of entities. Is it clear? Any questions on entity? No? Alright, of course, this is perfectly common sense concept. Now we move on to assets and liabilities. So balance sheet, different ways of presentations. I'm not one of the greatest accountants. I aspired in my early days when I was a sophomore, like some of you, to become a CPA and get accounting degree and all this kind of stuff. But money was a driver for me. I was a poor student, so when a fellowship or scholarship became available for a master's degree in economics, I went in economics for the money, all right? So, big money, free money, great education, University of Delaware, so I said, okay, I'll go and study economics. And then I got into master's and PhD, and there I am. All right, so, assets are, by definition of a balance sheet, on the left-hand side. So, balance sheet simply has got 2 sides. One of them is called the left-hand side. The other one is called the right-hand side. The left-hand side is called the left, all right, and the right is the right, simple as that. The left-hand side lists all assets. The right-hand side lists all liabilities. So, oops, liabilities. What is an asset? An asset is something of value, number 1. Number 2, we are able to benefit out of it. Number 3, we have a control over it. And 4, we actually own it and can dispose of it any way we like. Meaning, we can use it, we can abuse it, we can try to make money out of it, we can sell it. Please, on the back there, are you asking for a penalty or for a question? What's the question?
I think it's the third one of assets.
Okay, so what did I say first? An asset is something of value, right? What's next?
Benefit.
Okay, it's got a benefit. What's the third one? We gotta control it. Let's provide a great example of control. Yes, it is valuable. Yes, we can benefit. Yes, we can use it and all the good stuff. That's the sun in the sky that every morning, comes up. Sure, we can use it for all the good things. But we do not have control over it, okay? Moreover, we don't even own it. Therefore, the sun is not an asset. It is nobody's asset, all right? Same thing is with the rain, okay? Here's another example. Phenomenally valuable. Of course, the most valuable for all of us is the air that we breathe. So far, we don't control it, okay? And therefore, the air is not an asset of mine or yours or his, okay? Air satisfies most of these, but still, it is not an asset, all right? So, what would be an asset? Well, a table, a book, a watch, a pen, a machine, a taxi. So, it is some sort of property. Here's a keyword: tangible or intangible. Tangible means something that can be touched, seen, felt, and physically used. Intangible is something more of a right. You can't really see it or have it, but like a trademark, like a patent, okay? All of these are intangible assets. So, an asset is associated with something that we own, something that we have. A liability is associated with something that we owe to others. Liability is associated with one of two things. It is associated with an obligation to somebody else or somebody else's ownership. All right? So, let's explain this one step further. So, liabilities are usually divided into two parts. One is more like obligations, and the second part, I can kind of like draw here a line, we simply call capital. In accounting and in economics, we like also to call it equity. Equity is a stake of ownership, just as it is capital. Sometimes we call it owner's, I think like this, owner's capital. Anybody did accounting here? How else do we call it?
Owner's equity.
Owner's equity, yes. Owner's equity. And just in case that there is no confusion, there is yet another very common phrase, which is again the same thing, just different words for the same concept. It is equity capital. Equity capital. Equity capital. And then, when this applies, and here is the key word, specifically to a commercial bank, so when we're talking about a commercial bank balance sheet, the owner's equity or the capital has one special name. It's got a set phrase. In English it is called, again, only for a commercial bank, bank capital. It is important to understand that this is at least set in law, in accounting regulations. So anytime you talk about the equity side of a commercial bank, this is the one and this is the only correct term to use. Anything else for a commercial bank, causes confusion, possibly misunderstanding, and may have a lot of. So anytime you talk about bank, you just say bank capital, bank capital, bank capital. Nothing wrong with repeating 10 times bank capital if this is what you want to say and this is what you mean to say. Okay? Just like in math, you can say function, function, function. All this function. All right. Any questions up to here? None? All right. Let's move on to the next thing. We set up, and let's try now where I'm going to do this. All right, so loan banking, and with loan banking, let's see. The first example of a loan banking is what we call a money lender. Anybody know who or what is a money lender?
Probably somebody who lends money to other people and then asks them for return, but for the profit, of course.
Yes, that would be true. And how is this different from a commercial bank? How would that be different from a commercial bank? You're okay, but not okay enough. You see the point? Commercial bank does the same thing. What's the difference?
It doesn't intend to have a profit, maybe?
Oh no, money lenders are eager to extract profit.
Doesn't incur liability.
Okay, doesn't incur liability? Yes. Okay, let's put it this way. Bonus point if you can explain it.
I mean, he just doesn't. You don't have to sign a note payable, anything like this to get the money, like in the bank.
No, sorry, you missed your bonus. Okay, he doesn't incur the liability in the sense that he does not accept deposits and effectively lends his own money. All right? In other words, for a money lender, there is no liability. There is only owner's capital. So he works only and entirely with his own money and with his own capital. It could be his brother's capital. He's not attracting other people's money. So that's the money lender concept. So the money lender concept simply means, hey, I got 10,000. Let me try and make some money out of it. Of course they work for profit. Why else, right? They're not charities, all right? You got to understand, this is business. It is using money to make money. That's what it's all about, right? So let's try to do a money lender here. Well, how did the money lender work? He's got only equity. He's got his own equity. So he's got let's just write straight equity here because there is no liability, no obligation, no borrowing. How do we call the money lender? Well, let's just call it greedy co, meaning greedy company, right? So he just calls his greedy co, greedy company, all right? So greedy company would put in there some capital. Let's open up the money lender store, that's how they like to call themselves, with a capital of 10,000. Of course, 10,000, that's what textbooks love to use. So, if he opens it with 10,000, that will be his own capital. What form will it be? In what type of asset is he going to have it?
Cash.
Pure cash, yes, of course. If he puts in his house, it gets a different type of business. It's not a money lending business because just don't lend your house. If you lend your house, we call it in English renting. Yes, we just call it renting. It's a whole different business altogether. You have a car, you call it again renting. So it has got to be, if it's going to be a money lender, it has got to be cash, and the cash is 10,000. Now, balance sheets have have one magical property. The sum total of assets must always equal the sum total of liabilities and equity. In essence, whatever you have, someone must have financed it or ultimately own it. Alright? So sometimes the liabilities, and this is especially true for financial institutions, not just commercial banks, any financial institution, the liabilities are called, and let's write in here, sources of funds. Sources of funds. The guy will zoom in here, sources of funds. And on the other side, we call it uses, or uses of funds. The sources of funds, especially for banks, commercial banks, they have one major word. It's called financing. To finance means to raise money, to get money somehow, to raise capital. But capital is a bad word because capital's got like 5 different meanings in economics. So again, people understand differently capital. So capital, I'm afraid to use it unless it is in the strict sense of owner's capital or equity capital. All right, so we call this sources of funds. Sources of funds simply says how we got the money, and uses of funds or assets is what we use it for or where we invest. But again, invest is also a tricky word in economics because it has a whole bunch of meanings. But the standard meaning in macroeconomics for investment is remember it, purchase of a real asset, machine, equipment, taxi, computer, that will be used for productive purposes in order to help raise revenue and make a profit. Alright? That's what is a real investment, and that's what we mean in economics by investments, which has nothing to do with buying a stock, which is a financial type investment, okay? We don't count these in macroeconomics. Buying a bond, buying some other assets, which we purchase in order to get a return. Alright, so I'm explaining now the word capital a little bit more because it's important. So we've got to do an introductory macroeconomics. So, investment in this particular case. So investment, purchase of all sorts of financial instruments is not what we mean in macroeconomics. We mean the purchase of real assets. All right? Is that fairly clear? So, real assets will be examples: machines, equipment, truck, computers. This video recorder right here, everything that we use will be considered an asset. All right? Any questions so far? Back to greedy company. So he's got a 10,000 in cash. So he makes a loan of 7,000 makes a loan. How does he make the loan? Well, very simple. He gives 7,000 in cash to the borrower. So we got borrower A, and borrower A will get 7,000. So, my mistake here. I'll just say loan to A, loan to borrower A. A loan to borrower A becomes, again, I'm making now a transaction. So, what I'll do is cheat and just wipe off with my hand, but if you really got to do it right, you got to make a second balance sheet. So, loan A, 7,000, and the loan will be made with cash. I'll subtract 7,000 out of cash, so the cash becomes 3,000. And I will have an addition of course, if I give him money for 1 year and I'm a greedy company, I would want to make money on that money. We call this interest. So I want to also say interest payable, my mistake, receivable. So I will be receiving an interest on top of my, which is going to be, let's say, 500. Okay? So, oops, I am out of balance, right? So once I added the interest receivable, I gotta have something here. What's on the other side?
Interest income.
Interest income, and we can use both the words income or we can use the word revenue. Yes, so we can say interest slash revenue. Again, I don't want in this course to get me in the trouble of explaining the concept of revenue recognition, that you must recognize on the book the revenue only when it has been actually earned. In other words, only at the end of the period you actually can recognize the revenue. You know, it's going to be a little bit of a cheating if you recognize the revenue up front, you see. You got to first earn it in order to recognize it, but I don't want to get into that trouble. Alright, so when the revenue is actually earned and I subtract all of my costs and expenses, it ultimately translates or transforms or flows into what?
Zero.
Okay, what's the step? So I got a revenue, what's the next step? Meaning I already earned it, they already paid it to me, it becomes to me,
Capital.
before that, a profit. Alright? So the revenue, once it's actually earned, once you subtract from it all expenses, so this becomes, we call it in economics, in accounting, operating revenue. On the other side you have the operating cost. The difference becomes operating profit. So once you get the profit, at the end of the period, you can transfer your profit to your capital or to your equity. Do you understand that? Because it's common sense. In other words, I have 10,000. What we call in English, made 500. Made mean I actually earned it and I actually collected it. And now my business is worth 10,500. So, in order to balance the interest receivable of 500, I recognize here step 2, interest revenue of 500. Alright? That's the second step. Now, the third step is time passed, I really earned it, he really paid me back in cash and everything's good, and I'm back in business, meaning I got all my money back. What's on the left hand side? What's on the right hand side?
On the left hand side it's $10,500 of cash.
Okay, hold on, let me write this out. So, loan to A has been paid, and the receivable has been paid. This means loan to A goes down to 0 and cash goes up. It's paid in cash. So these two get wiped out and I am back to the original 10,000 in cash and to an additional 500, which is kind of like my profit. But it is still 10,500 is actually what I get in cash. Alright? And what happens over here?
Over here we have $10,500 of greedy company's equity.
Equity. Okay, so interest and revenue on the intermediate step becomes profit 500, and then we transfer the profit to the capital. Can you come up with the name of the transferring profit to the capital? How? No, the income summary, that's the statement itself. What is the process of transferring a profit?
Closing entry.
Yeah, no, that's how we call the entry.
It's capitalization.
That's the bonus point. Well, you also got for all the participation. That's the bonus point. This is the perfect one and only correct answer. It is called capitalization. So, capitalization is the process at the end of the accounting period that transfers part or all of the profit to the capital. Remember, we made profit. Well, okay, let's try it. Let's just go to accounting a little bit. So, I think somebody asked before, a couple lectures before, whoa, what can we do with profit? With profit can be done one of two things. So, you can do only two things with profit. Number one is you can pay out, meaning return back to the owners in the form of an asset, usually cash. Of course, could be another form, could be stock, could be, I don't know, chairs, tables, computers, whatever. And so, you either pay out, and the name in accounting is called a dividend. So, this is the same as dividend. Now, let me emphasize, a lot of foreigners make the mistake. Dividend in English is actually with the letter D. In Bulgarian, dividend is with T. So, Bulgarians love to, mistake it. How is in Russian, is it?
With D.
D. Oh, so Russians, you're not prone to this mistake, but Bulgarians love to make it. So, dividend. Sometimes it is also simply called dividend payout, okay? And the other thing is meaning one of two things. You either get it out of the business back to the owners or put it back in the business. So, when you put it back, it's called pay out. It is called plow back. That's what accountants love to call. We have a nicer, better, perfectly understandable by anyone in the world. We call it reinvestments. Reinvestments. And now we get back to where I, sidetracked the capitalization. Capitalization is the process of accounting for reinvestment back into the business. In other words, part of it will be paid out in a dividend, the other one is reinvestment. So, capitalization is the process of accounting the reinvestment. So, he might get some cash and actually enjoy his profit, or he might just put it back. So, at this point, we just say he went out and actually reinvested it all. So, we're to 10.5 and we're back in balance, alright? So, question now. Okay, let's do here. Let's do here. Is this process inflationary where you actually had 10,000 and now you have 10,500? So, at the end of the transaction, was the transaction's nature inflationary or not?
It was not inflationary because the money supply didn't increase, because we gained it, the person lost.
Yes, we gained it, it's another person. We can't just say he lost it. Meaning our balance of 10,500, our balance increased by 100 because someone else's balance was reduced by 500. So, the increase in one's balance was, what's the word in English?
Compensated.
Yes, what's the compensate?
Counterweight.
No, what's the word? The simple, the offset. Yes, compensate, that's how we call it in Bulgarian and Russian, but the English word is offset. So the one's increase in balance was offset by an identical decrease in someone else's. So, inflationary, and the answer is no. That's the first most important property with huge implications in general for macroeconomics, is that loan banking by its nature is not inflationary. Alright? Now, let's see, I kind of spread around a bit. So, let's try and make a quick second transaction, and you will guys read in the textbook, there are like 4 of them, right? So, let's just say borrow. Borrow 7,000. This is a liability. I put in here for your help, but no accounting book will say it's an obligation. So, the bank borrows 7,000 for 1 year, and it will use the money to make money, meaning to make a profit. So, the way a commercial bank, meaning in this particular case a loan bank, will make money is it will borrow and pay 1 interest rate. So let's put in here a tiny little, let me see here, borrowing at 6%, and then we loan it or lend it, meaning greedy company lends it at a higher interest rate. Alright? So let's try to do this. First of all, we have 7, we gotta counterweight. So the next balance sheet, instead of 10.5, we add 7 on the left hand side, and 10 becomes 17. We're back in balance, alright? Next, we lend, what? I don't know, 10 grand to somebody to buy him a taxi, alright? Second-hand taxi. So, loan to B, and we lend 10,000, and therefore from 17.5 my cash becomes 7.5. I like to use the round number because I can do the trick by wiping off with my finger, and I'm done. Alright? So, again, he will use the taxi, he will provide a valuable service to society, transporting people from one spot to another, which they are willing to pay for. So it is a productive transaction. Sorry, the loan itself provides for increased productivity or higher output. So, inflationary, yes. Inflationary, my mistake. No, productive. Let's put it, sorry guys, let's put it here with red. Yes. Here we gotta stipulate that it is socially productive. It provides possibly some sort of a service. Of course, it could be a machine, it could be a product, it could be anything else. So, the most important lesson to learn and understand about loan banking is that its nature is that it is not inflationary and productive. Okay? It is healthy, it is good. Whoops, I forgot to mention here, 6% is what we borrow money from, and this we charge for loan B. We're greedy, so we charge a whole lot more, like 12%. Okay. So, the difference between the cost of borrowing and the cost of lending is called, come on guys, it's an important concept, interest rate differential. Interest rate differential. Or sometimes it's simply called interest rate spread. And some would like simply to call it the interest spread. Of course, bankers in the bank will not waste the time on the word interest, they'll just call it spread. Alright? Is that fairly clear? So, interest rate spread, interest spread, or simply spread. This is the difference between, we call this cost of borrowing and return on lending. So 12 minus 6 is 6. So loan lending is also profitable. It is profitable, has the function of raising money and channeling it or transferring it to the most profitable business, most reliable and most socially productive. As such, it provides a socially productive, valuable, non-inflationary service to society. Like any business, it is subject to entrepreneurial risk. You screw up and give it to the wrong borrower, and you go bankrupt and get wiped out. Alright? So, any other business, you do well, you give it to the highest bidder, meaning if somebody is willing to give 13%, you give it to him, subject to the same risk level, of course. And if you make a mistake, you get punished for it. Simple as that. Any questions? Because I am willing, we have 15 more minutes, correct? To move on to only section 1 of the next chapter. Alright? Any questions on, what is this? Loan banking. Any? Yes?
Why most of the so-called commercial banks in Bulgaria involved in investment functions like mutual funds and...
Okay, again, they are trying to make money any possible way. The short answer could be they're greedy. They want to make most money in the simplest and easiest way. The answer is because, according to U.S. regulations, commercial banks cannot engage in investment activities. European regulations allow that. So, many or most actually European banks will engage, besides making loans and accepting deposits, in actual investing activity. Yes, this is permissible in some countries. My understanding is that it is also permissible in Japan too. So, if they can do it, they will do it because they will find that investing in security is more profitable than making loans, or they simply have more funds to invest than they can loan. So if you have surplus funds and you can, provide loans for all of them, the surplus you would like to earn something on it, so they invest in something. Alright, of course, for commercial banking, and I really don't want to get into the topic of portfolio theory and risk management, but for any financial institution that invests, or like a bank, you have to always account for the trade-off between risk and return. You always want to get the highest return for a given risk, or for a given risk, you always want to assume the lowest possible return. This is the risk-return trade-off. So you want to get as much return as possible for a unit of risk. You had a question?
Yeah. So basically, I think there is like 15% of money that people can withdraw from bank. For example, like 85% are not able to be withdrawn. Like, they invest and the certain amounts can be withdrawn, like 15% or something.
Again, what do you mean can be withdrawn? Means the contract says you can, or the money is simply not in the bank, so even if you want it, it's not there.
Just a statistic. So in US, the remaining like 80 or 85%, they're just laying and they're doing nothing.
No. You're telling that American bankers are that stupid? And that Bulgarian bankers are so phenomenally smart that Bulgarian bankers use all the funds and invest it in everything, and American bankers just...
Yes, so what are they
No way. Okay, so let's clarify. What you're saying is, as a fact, dead wrong. It is incorrect and it's not. commercial banks in the United States keep anywhere between 3 and 5% of all of their deposits and all of their balance sheet in cash. It is a tiny, minute fraction, anywhere between 2 and 5%. Some will say, oh, but they have minimum reserve requirements. They have to maintain a certain percentage. Back at least a while ago was 10% out of all deposits. This is true, but bankers got their way around these regulations so that they actually maintain less. Why would they want to maintain less? Well, of course, if you maintain less, you actually use it to profit out of it. That's the business of bankers. That's what bankers do. They try to use every single penny that they have and make money on it. And if they don't, they'll be thrown out of the shareholders and someone else will be put in there. If what you were saying were true, American shareholders will just throw out American bankers and, take an airplane out of American bankers and install them over there. Well, this is not happening because American bankers are using every penny. Now, whether they use it good or bad or proper return or risk, I don't want to get into that. That's not what we're trying to do today. We're trying to do is simply identify the next step. So, again, what was the question that they had?
I was actually asking for what do they use them.
Well, they use it mostly for making loans. They provide loans for cars, for personal consumption, for vacations, for businesses. Of course, the biggest market has been real estate. They provide the big chunk of money on mortgages. They just give people money to buy a house. Another big loan has been construction. They provide a major construction real estate company a couple of million to build a bunch of houses. Now these are examples. Commercial and investment loans. You just build a brand new factory. You had a question?
Actually, what I wanted to ask is about construction. What's the share of spending money on construction?
Well, unfortunately, again, you always have to ask.
For example, in Bulgaria.
Oh, well, in Bulgaria, it is tiny. It is tiny. We're not really putting our money to productive investment. Oh, in China, it's huge. In America, it's extremely low.
In Russia?
In Russia, it's somewhere in the middle. Russia is now more on the consumption bench. With oil prices skyrocketing, you guys wouldn't want to bother to work hard. My money is flowing out of the ground. You just pump it up and sell it, and you don't need to have productive capacity, just like Saudi Arabia and other Qatar wouldn't need all these productive capacity. You can just make money out of, nothing, meaning out of the ground. So, but China doesn't have it. China's got to have a factory to produce a watch, a DVD, a VCR, all the other things that we buy, Chinese. Let's try again. More questions. No more. Let's try. We have 10 minutes. That's good enough, at least for me, to move on to the next section. And the next section will be of deposit banking. And of course, before we get to deposit banking, we got to get a more general concept of warehousing. So, number one, warehouse or warehousing. Warehousing is the business of running a warehouse. So, what is a warehouse? Guys, give me some of the key characteristics of a warehouse. What's a warehouse?
It's a place where you can go and just leave some things, maybe for 50 years or something.
Alright, so the key word when you leave it, and what are they going to do with it?
They're going to secure it.
Store. So, store. So, store. Sometimes the nicer word in English is safeguarding. You know what safeguarding? Everybody understands good. This is something given to somebody else, and this person will take care as if it is his own, even though it is not his own. So storage slash safe guarding. Why would the warehouse provide this service? Why would they provide a service to you? Or you? They will make money, yes. How do they make money?
They take a percentage for keeping money.
They take a, okay, wait a minute. I never said money. Warehouse could be, let's clarify. Warehouse could be for grain, meaning for wheat. It could be for cooking oil. It could be for crude oil. It could be for gasoline.
Furniture.
Yes, it could be for furniture. Warehouse is very popular in the United States. We're just, moving or whatever. You just leave there your furniture. We call it just stuff, right? Just leave your stuff. I mean, you can warehouse your books. I mean, you can warehouse your, clothes. So, warehouse could be for practically anything tangible, okay? So, this is the kind of warehousing we're talking now, all right?
It would be intangible for data warehousing.
all right, well, I don't want to get into that anyway. Well, we're not into data warehousing, so let's try. So, storage and safeguarding. So, next thing, how do we call the money that you pay to that warehouse for the, and here's a key word here, service. For the service of storage, or for the storage service, how do we call the money?
Service charge.
Service charge or service fee or storage fee. So, you leave your clothes with the storage. Is the storage owner becoming temporarily the owner of your stuff or of your books or clothes? No. The answer is no. Yes, this is the meaning of a warehouse. You give your property to safeguarding without actually transferring the title of property. No sale slash buy, which is the same as no transfer of property. No transfer of ownership. No transfer of the ownership of the property itself. This is, again, very important, all right? So, there was one more I will try to remember. Let's try and see what's coming up next. All right, so loan banking, warehouse. Oh, okay. So, you give the warehouse your, let's say, watches and whatever. They're going to give you back what? Initially. When you deposit it, they're going to give you a piece of paper which states or says that you actually gave it to them. Okay? So we call this document a warehouse receipt. For the receipt, there is P, and the P in English is not pronounced, okay? So no one should pronounce the receipt. No receipt, only receipt, okay? So, warehouse receipt is the actual document that the warehouse issues when you deposit your property. So, here is the next key word that I used, and that is of deposit. So now I'm making the connection which I did not make up to this point. The key word here is deposit, and I'm talking or beginning the topic of deposit banking. So let's try to clarify the meaning of the word deposit, because it has a very special meaning that you must understand, and understand the difference with the previous example. The meaning of deposit is that you can take it back at any time. Remember, in the previous example, let me repeat and let me emphasize, I said that the second last transaction, the bank borrowed 7,000 for 1 year. When you have a warehouse, there is no transfer of title and there is no period. I pay for as many days or weeks or months that I hold it. It is a deposit in the sense that at any point in time I can walk in back and take it back. Okay? So the key word for this in English is on demand. On demand. So on demand means that at any point in time the depositor has the right to demand it, and the warehouse must return it immediately on demand. Alright, that's what it means. That's why for a commercial bank comes the term demand deposit. A demand deposit for a commercial bank is a deposit which the depositor can withdraw at any time without any notice and without any restrictions or limitations. Is this clear so far? Alright, so let's see what's next. Warehouse receipts, alright. Alright, this whole process of warehousing and everything else crafted and written in law is called simply bailment. So it is a bail or bailment. So bailment is the technical legal term used in the law and courts of law regarding the process of warehousing as described here. Now, the second to understand is that this warehousing is its nature is bailment, and it is not a loan. Oh, so now I gotta explain what is a loan. So, a loan is an exchange of present goods for future goods. So, a loan is, and let's put in, I'm trying to see an equality sign. Loan is the same as credit. Transaction. So, loan equals or is identical to credit transaction. So, a credit transaction or a loan is an exchange of present goods for future goods. So, a present good now is something that we can have today and possibly use, consume, or benefit today. A future good is a claim on that good, but at some point in the future. So, credit transaction means the exchange of present and future. Of course, as is human nature and natural to human beings, we always want to have it sooner rather than later. So, one car is always more valuable if you have it today as opposed to 2 years from today, or 10 years from today, or 50 years from today. So the present is always more valuable than the future, okay? And if it's more valuable, if we're going to be exchanging present for the future, whoever gets the future must be compensated to wait for that future, okay? So that future compensation is called interest. Alright, so that is called interest. So interest is the compensation in a credit transaction in order to, and here's a key word, forego present consumption for the future. Now, the interest is not the future good. It is only the difference above and beyond the present good. And now let's try and provide the key word. How do we call the present good itself? No, it's not an asset.
Liability.
No.
Version.
Principal. 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 And let me finish with the last point 4, which is very short and very straightforward. When you have a warehouse, okay, like any of these warehouses with all the properties that we've discussed, and that warehouse specializes in the business of warehousing money. So when you have a money warehouse, which is a warehouse specializing in the business of money, we simply call it a
Bank.
Deposit bank.
deposit bank. Alright, so there you earned today your bonus point. You were a hair from losing it with another penalty, but you know, you got your bonus point. I am done for today with the introduction of understanding what is a bank and understanding what is a deposit bank, and I will continue next time from here. Alright, thank you very much and enjoy your vacation.